An exchange didn't just warn traders, it moved the dials. In Shanghai, the gold deferred contracts saw margin requirements lifted to 17%, and the daily price limit widened to 16%, while specific contract lots were suddenly asked to carry far more cash per position. On the same week, the silver deferred rules shifted in the opposite direction on margin, while tightening price limits right as silver was coming off a publicized peak near $121 an ounce and sliding toward the $77 area. For years, people repeated the same comforting line. Major commodity venues are too deep, too regulated, too professional for coordinated stress to show up in public. They said the plumbing is boring, that it functions, that it can't surprise you. But it does surprise you, and it always surprises you the same way. First, the move looks like speculation. Then the exchanges change the rules. Then the forced selling happens. Then, after the headlines, the quiet data starts to tell the real story, where the pressure actually was, and who had already repositioned before anyone else realized what the market was about to do. Here's the part no one is discussing. When an exchange adjusts margin and price limits, it's not an opinion. It's a statement of risk. It means the venue believes volatility is not just possible, but likely, and that it must reduce the chance of cascading defaults. That is the exchange admitting, in the most practical language it has, that the market is approaching a stress point. And when you see multiple venues tightening or reshaping risk controls around the same moment, you're not watching random coincidence. You're watching a system responding to the same stressor from two sides of the world. Welcome to Channel Name, where we decode what matters before its headlines. This is where we read the filings, the margin notices, the delivery reports, and the spreads that institutions watch first. If you like analysis that treats the market like a machine with gears, not a casino with vibes, you're in the right place. And if you're listening like the wise elder in the room, consider subscribing so you don't miss the next piece of plumbing that tells you more than 1,000 price charts. Also, drop a comment with where you're watching from, because the geography of this story is the story. Now let's reconstruct what happened step by step, like a forensic report. On February 3rd, Shanghai's exchange announced adjustments for the silver deferred contract, the kind of notice most people never read. The margin requirement for Ag T plus D was set to move from 26% down to 23%, and the price limit was set to move from 25% down to 22%, effective from the close. That combination matters. Lower margin makes it easier to hold a position. Tighter limits in a volatile market makes it easier to hit a cap where trading behavior becomes distorted. Then, on February 4th, another notice hit, this time centered on gold deferred. The margin requirement for a basket of deferred gold contracts was increased from 16% to 17%, and the daily price limit was widened from 15% to 16%, again effective from the close. 99 from 120,000 yuan to 150,000 yuan. That is a 25% jump in cash required per lot, not because the underlying metal changed, but because the venue decided the risk did. If you've never traded derivatives, think of margin as the hallway width in a crowded building. When it's wide, people can move without bumping. When it narrows, bottlenecks form. When the exchange changes that width overnight, it changes who can stay in the building. Traders who don't have extra cash get pushed out, not because their thesis is wrong, but because their balance sheet is insufficient for the new rules. That's forced selling, not emotional selling, mechanical selling. So here's the central mystery. At the same time that Shanghai was modifying these core controls, the broader metals market was already expressing instability in a way mainstream outlets couldn't ignore. Silver had experienced a dramatic surge, and then an equally dramatic slide, with public reporting describing a peak around $121 an ounce and a decline to roughly $77 by February 2nd. The narrative was simple: a speculative burst, then margin shifts in multiple venues forcing liquidation. The deeper question is, why were exchanges compelled to move the dials in the first place? And what was happening underneath the price that made this necessary? To answer that, you have to zoom out and look for the hidden pattern. This is not the first time the paper side of metals and the physical side have pulled in opposite directions. And it's not the first time margin policy has acted like a lever to bring the paper side back under control when it gets too far from what the system can comfortably settle. Go back to 2008. The global financial system seized and liquidity vanished in places that were considered liquid by default. When leverage is cheap, the trade is crowded. When leverage is pulled, the crowd becomes a stampede. In commodity markets, that stampede often looks like a sharp crash, even if the long-term thesis remains intact. The outcome was violent repricing, followed by a restructuring of risk appetite and a renewed focus on what could actually be delivered, financed, and cleared. And look at 2011. Precious metals hit a fever pitch, especially silver, and the market became a battlefield between enthusiasm and constraint, Risk controls tightened, margins shifted, and positions that were built for smooth trends were suddenly forced into exits. The outcome was a sharp drawdown that left many convinced the move was over, but the larger pattern was that the system used margin to cool the paper side, while physical interest did not simply vanish. The crash was not just a verdict on value. It was the clearing system reasserting control over leverage. Then look at 2020. A global shock, logistical constraints, and a sudden demand for settlement certainty created dislocations that shocked even seasoned traders. Spreads widened. Premiums behaved strangely. The question became less about the headline spot price and more about whether you could source metal, move it, and settle it on time. When those questions get loud, exchanges and dealers focus on controlling risk. And the fast way to control risk is always the same. Change margin, change limits, change eligibility, and force the weakest balance sheets to de-risk. Now in 2026, you're watching a familiar playbook, but with a twist that makes it more important. The twist is the East-West split. On one side, Western futures venues are still the global reference for paper pricing and hedging. On the other, Shanghai has become a focal point for physical throughput and domestic pricing signals, with its own constraints, policies, and demand patterns. When those two worlds are calm, their prices and flows can look synchronized. When stress hits, they reveal their differences, and those differences become the fault lines where the next move is born. This is where the institutional movement matters. Retail eyes usually go to a chart. Institutional eyes go to settlement and delivery, because that's where the real exposure shows up when volatility hits. On the Western side, the CME delivery reports don't tell you everything, but they do tell you something most people never look at: which firms are issuing metal and which firms are stopping it, meaning who is delivering and who is taking delivery. In the February delivery cycle for COMEX Gold, the report shows major names active in issues and stops, including firms like Goldman, Deutsche Bank, HSBC, JP Morgan, Citi, BNP Paribas, and Morgan Stanley, alongside the total counts on the page. When those names appear in delivery flow, it should change how you interpret the rest of the week. Because if the market were simply a speculative bubble popping, you would expect the system to relax into normality afterward. But when exchanges adjust dials and institutions are active in settlement, what you are often seeing is a controlled burn. The market is venting pressure in a way that keeps the clearing system intact. Now let's talk about the dislocation, because this is where the coordination no one wants you to notice becomes visible. On paper, a price drop looks like demand disappearing. On the physical side, you can see whether metal is leaving the system, because physical markets have a crude but powerful metric: withdrawals. Shanghai's own published data for January shows gold withdrawal volume of 125,781.4 kilograms. Let that number land. That is 125 metric tons of gold withdrawn in a single month, moving out of the exchange's vaulting system into private hands, fabrication channels, or inventory pipelines. In the same January data, Shanghai reported a gold delivery ratio of 44.8%, reflecting delivery volume relative to trading volume. Those are not abstract statistics. They are physical throughput and settlement intensity. They describe a market that is not just spinning contracts for sport. They describe a market where a meaningful share of trading ends in delivery and where large quantities are being withdrawn. So here's the contradiction. If paper prices are collapsing because the metal is suddenly unwanted, why does the physical withdrawal data remain massive? Why does the system show ongoing delivery intensity? The answer is that the paper market and the physical market are not the same creature. The paper market can be pushed by leverage, forced selling, and risk controls. The physical market is pushed by demand, inventory management, financing conditions, and policy. When those forces diverge, you get a dislocation that can last long enough to confuse anyone watching only one side. Think of it like an airliner and its luggage. The plane can change speed and altitude quickly. The luggage is heavier. It moves on conveyors. It has constraints. If the plane suddenly drops, the luggage system doesn't instantly synchronize. In markets, paper can drop fast. Physical adjusts slower. And when the gap gets too wide, something has to reconcile it, either by paper rebounding, physical slowing, or the spread between them widening until arbitrage becomes irresistible. This is why margin notices matter so much. They are part of the reconciliation mechanism. When the system senses that paper leverage is creating price movement that could destabilize settlement, it alters the rules to force a rebalancing. That rebalancing often looks like a crash, but the crash is not always a clean signal about underlying demand. It is a signal about underlying stress. Now let's layer in the mechanics, because once you understand the mechanism, the week looks less like chaos and more like engineering. Imagine a trader holding a leveraged position in a gold deferred contract. At 16% margin, they can control a certain notional exposure with a certain cash buffer. When the exchange raises margin to 17%, their required cash rises immediately. If they have spare cash, they top up. If they don't, they must reduce the position. And position reduction in a falling market is not gentle. It hits bids, it accelerates moves, and it can trigger other risk controls. Now add the other dial, price limits. When price limits widen, the market is allowed to move farther in a single session. It also means risk models that assume normal ranges are suddenly less reliable because the venue is explicitly allowing a larger range. Again, this is not neutral. It is the exchange telling you the normal range is no longer normal. In silver, the combination was different. Lower margin means some participants can maintain exposure more easily. But tighter price limits can create sessions where the market hits its cap sooner, which can create pent-up orders, which can then release in bursts when trading resumes, that can amplify volatility rather than reduce it. So if you're wondering why an exchange would make that combination, the answer is that it might be trying to maintain participation while still controlling runaway moves. But in practice, it can also redistribute volatility across time in a way that looks like sudden cliffs on a chart. Now zoom out to the cross-venue angle. If Western venues increase margin while Shanghai adjusts its own controls, you can get a synchronized tightening of leverage across the ecosystem. That doesn't mean the venues are colluding in some dramatic sense. It means they are responding to the same volatility and the same risk of participant failure. But from the outside, the effect looks coordinated. Leverage gets pulled, forced selling happens, price resets lower, and the settlement system remains intact. This is the part most people miss. The goal of an exchange is not to make prices go up or down. The goal is to ensure contracts can clear, margins can be collected, and defaults don't cascade. When volatility rises, the exchange's duty is to protect the clearinghouse. That protection often comes at the cost of traders who are over-levered. It is a transfer. It moves losses from the clearing system to the weakest hands. And it does it fast. So what does the evidence say beyond the notices and the headlines? First, the Shanghai numbers show a physical market with heavy throughput. 125,781.4 kilograms withdrawn in January. A delivery ratio of 44.8%. That is the kind of data that suggests ongoing physical engagement. 99 from 120,000 yuan to 150,000 yuan tells you the exchange wanted less leverage in that specific product. It is not a general statement. It is targeted. It says, in effect, that the cost of carrying that exposure just rose dramatically. Third, the presence of major institutions in Western delivery flow during the same period is a reminder that settlement behavior continues even in volatile weeks. When large firms are issuing and stopping, they are managing physical and paper exposure together, not just chasing price. They are adjusting inventory, financing, client hedges, and risk. Now here's where it gets interesting. A dislocation like this cannot persist indefinitely. The system has only a few ways to resolve it. One resolution is that paper prices stabilize and drift back toward where physical demand is willing to transact, narrowing spreads and reducing the urgency for margin interventions. That tends to happen if forced liquidation exhausts itself and the market returns to a more balanced participation. Another resolution is that physical demand softens, withdrawals slow, and the physical market stops, pulling metal as aggressively, allowing paper prices to remain lower without causing persistent tightness. That can happen if policy changes, if credit tightens, or if buyers decide to wait. A third resolution is that the gap between venues becomes the story. When one market prints one price and another market signals a different reality through withdrawals and delivery behavior, arbitrage becomes a magnet. But arbitrage in metals is not frictionless. It requires logistics, regulatory compliance, financing, and trust in settlement. When those frictions rise, spreads can stay wide longer than you'd expect. And that is when the system becomes most fragile, because frustration builds and participants start to question the reference price itself. There's another layer that often hides in plain sight: the basis and the behavior of bridge transactions between futures and physical. When stress rises, the market starts to pay a premium for certainty. That premium doesn't always show up as a higher headline price. It can show up as a stubborn spread between nearby and deferred contracts, as unusual urgency in rolling positions, or as a sudden preference for converting paper exposure into something deliverable. In plain terms, the market begins to separate trading from settling. The easiest trades remain cheap and liquid, but the trades that require moving metal, financing it, or guaranteeing delivery become more expensive and more selective. This is why headlines can feel calm while participants on the inside feel the system tightening. They aren't looking at the same thing. One side is looking at prints on a screen. The other side is looking at friction. When you notice those frictions rising, remember, the price you see is the cheapest price to trade, not necessarily the cheapest price to settle. That difference matters most in stress for real participants. So what should be watched? Not as a prediction, but as a pattern. Watch margin notices first. They are the earliest public admission of stress. If margins keep rising, it suggests volatility is not resolving. If margins normalize, it suggests the clearing system believes the danger is passing. Watch delivery intensity and withdrawal flow. If withdrawals remain high, even while paper prices sag, it suggests physical demand is absorbing metal, which can set the stage for future tightness. If withdrawals suddenly drop, it suggests physical demand is stepping back. Watch the behavior of settlement participants. If major dealers remain active and the system clears smoothly, it suggests the reset is being managed. If the system shows signs of strain, such as unusual delays, abrupt policy shifts, or persistent premiums, it suggests the pressure is migrating from charts into logistics. Historically, when you see the sequence of surge, margin tightening, forced liquidation, and continued physical pull, the market often enters a phase where volatility compresses and then breaks. Again, because the underlying disagreement between paper leverage and physical flow hasn't been resolved, it has been paused. In 2011, the crash did not eliminate the debate. It changed the participants. In 2020, dislocations revealed the limits of assumptions about frictionless settlement. In 2008, stress exposed how quickly liquidity can vanish when everyone needs cash at the same time. In 2026, the same lesson is on display. The data suggests the system is trying to control risk in real time, using the tools it has always used, while physical markets continue to express their own logic. And this brings us to the divide. There are people who will remember this week as a wild move on a chart. They will talk about it as entertainment, as a crazy spike and drop, as a story about sentiment. Then there are people who will remember it as a moment when the exchanges told you, in plain mechanical language, that risk was rising, and when physical data hinted that demand and settlement were still very much alive. This isn't about being smarter. It's about paying attention to the right signals. The information gap becomes a wealth gap, not because someone is magical, but because institutions track constraints and flows while retail tracks excitement. Institutions move first because they can see the plumbing. Retail moves last because it sees the headline. If you take one thing from this, let it be this. When you see margin and price limits change across major venues, you're not watching an isolated event. You're watching a stress response. And the way you understand that response determines whether the next phase feels like a surprise or like the continuation of a pattern you already recognized. This is Channel Name, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether markets will keep testing the edges of their own rules. The question is whether you'll be paying attention to those rules before the next test begins.